After nearly 5 years, Parikh Fund House has launched a new active mutual fund in the large cap category. It's called Parikh Large Cap Fund. What is very interesting is, while every fund house has various mutual funds under each category, Parikh Fund House has only 3 equity mutual fund offerings. First is very popular Parikh Flexi Cap Fund that today commands an AUM of 1.33 lakh crore rupees. Second is Parikh ELSS Fund that also offered tax benefit under Section 80C. And now this Parikh Large Cap Fund. It essentially means they don't have a mid cap fund, they don't have a small cap fund, and they don't have any thematic fund. So instead of launching a mid cap or a small cap fund, they choose to launch a large cap fund. Now I don't know how many of you closely track Parikh Fund House, but personally I am a big fan of their investment style. So I always say that when it comes to mutual fund investment, you can't just look at just past 6 months or 1 year or 2 year of return and select the fund with highest return, because there's no guarantee that if a mutual fund has outperformed in last 6 months or 1 year or 2 year, it will continue to outperform in future. In fact, in many cases, if the fund has outperformed the benchmark or category peer in last 1-2 year, chances are high that it can underperform in near future. And majority of people end up making this classic mistake of shortlisting mutual funds based on past 6 months or 1 year of performance. So for me, equity mutual fund investment is not for next 1, 2 or 3 years. For me, it's a long-term investment. 5 year, 10 year, and sometimes even more, like till retirement and beyond. And if you simply buy a mutual fund based on last 6 months or 1 year of performance, the moment that mutual fund would underperform, you would panic and exit the fund. And then you would again buy the new fund with past 1-2 years of outperformance. And when that fund again underperform, you would sell it and start hunting for a new fund. That way you would keep selling and buying new funds, and that would completely mess up your portfolio returns. So if I invest in a mutual fund, I try to go deeper. I focus on understanding the investment style of the fund house and the fund manager. Some fund houses like value investing, some go for momentum. Personally, I am more inclined towards value investing, and I completely align with Parikh Fund House investment style. What it means is, even if their fund underperform, which I'm sure it will at some point in time because no fund can consistently outperform, but in that case, I won't sell it. And that's why this new fund offering from Parikh, which is already very selective in launching new equity fund, made me curious. What is the thought process behind this new fund? Especially when they already have a flexi cap fund that has become so big that it would almost act like a large cap fund. So those who are already invested in Parikh Flexi Cap Fund, should they also consider this large cap category? Another point is, data suggests majority of active large cap funds struggle to beat their benchmark. So why would anyone opt for Parikh Large Cap Fund versus a simple Nifty 50 or Nifty 100 index fund? So first of all, if you are new to this channel or someone who is looking to build a mutual fund portfolio, I would strongly recommend watching my recent video on mutual funds for 2026. It's a 17-18 minute video where I've explained all common mutual fund investment mistakes and how you can build a mutual fund portfolio. Second, if you're new to the world of equity investment, I would strongly recommend reading one of the books from late Mr. Parikh, who is the founder of Parikh Fund House. And the book is Value Investing and Behavioral Finance. I keep saying that in today's world, we all have access to information. Every single result or announcement is available within seconds. So information is no more a moat in investing. The single biggest moat is human behavior. How we react to any news. How we build patience and conviction. How we control our emotions of fear and greed. And that's what you will learn in that book. Okay, now let's have a quick look at the key features and offering from this newly launched Parikh Large Cap Fund. So first of all, when I checked their presentation, the first slide says, what is this fund trying to do? And it clearly mentions, the fund seeks to provide low-cost, broad large-cap exposure with implementation designed to reduce trading and impact cost while keeping returns close to the index over time. So 4 keywords here: low-cost, broad large-cap exposure, reduce trading and impact cost, and return close to index. Basically, it is a very boring fund. So in case you are looking for excitement, this fund is not for you. In fact, they've clearly outlined that this fund is ideal for investors who want broad exposure to India's top 100 companies by market capitalization, prefer lower cost compared to typical active funds, value a strategy that aims to deliver index-like return, have a long-term investment horizon, more than 5 years, understand that equity investments can be volatile, and appreciate technical efficiency in implementation. And they've clearly outlined that this fund is not suitable for investors who seek to significantly outperform the index, want concentrated bets on specific stocks or sectors, prefer active stock selection based on fundamentals, have a short-term investment horizon, cannot tolerate equity market volatility, and expect the fund to avoid overvalued stocks. So the first key feature of the fund is broad diversification. Here this fund house would take exposure in India's top 100 large cap companies. Now you might ask, why Nifty 100? Why not Sensex or Nifty 50? The reason is better coverage. Top 100 companies of Nifty have 68% market cap coverage versus 40% and 50% of Sensex and Nifty respectively. And top 100 companies contribute 76% of total profit pool versus 46% and 56% contribution from Sensex and Nifty 50 respectively. Second feature is, it is a low cost active fund. Unlike other active large cap funds that usually charge a fee, that is expense ratio in the range of 0.6 to 1% for direct category, Parag Parikh large cap fund expense ratio is just 0.15%. Clearly this looks like the lowest cost active mutual fund. In fact, this expense ratio is similar to large cap index funds. That's a big plus. Now the big question is, can Parag Parikh large cap fund outperform the benchmark? Because historical data suggests that majority of large cap mutual funds underperform the benchmark over the long term. On that, Parag Parikh team has laid out a few smart execution strategies that can help the fund potentially achieve alpha over the benchmark or generate similar return to benchmark. Now this is very important to understand. The first strategy is smarter rebalancing. It basically means when an index announces a change, say a stock will be added to Nifty 100 or removed, this information is public and known weeks in advance. Everyone knows the exact effective date. Now all index funds and ETF tracking Nifty 100 are forced buyers and sellers. If a stock is added, they must buy. If a stock is removed, they must sell. So what happens is, sometimes when the stock is getting added to the index, traders start buying the stock days or week earlier. As a result, the stock price run up before the effective date. And on the actual rebalancing day, index funds may end up buying at inflated price. And when the stock is getting removed from the index, traders short or sell the stock in advance. So the price fall ahead of the event and index funds are forced to sell at lower prices. This phenomena is called index inclusion-exclusion effect. But since Parag Parikh large cap fund is not an index fund, there is no compulsion to buy or sell the stock immediately. They can rebalance gradually. So this can be one useful strategy. Then second strategy is opportunities related to special situation like demergers. For instance, recently ITC Hotel got demerged from ITC. Now all ITC shareholders received ITC Hotel share. But since ITC Hotel is not part of Nifty 100, all index funds had to sell it. But active funds need not sell it immediately. Then third strategy is merger related opportunities. Basically, when a company in an index is merging with another firm, you buy the stock which is at a discount to the merger ratio. They've taken example of HDFC Bank and HDFC Limited, where 25 shares of HDFC Limited get 42 shares of HDFC Bank. On 13th April 22, HDFC Limited was at 3.3% discount to HDFC Bank. 25 shares of HDFC Limited were valued at 59,462 rupee and 42 shares of HDFC Bank were valued at 61,528 rupee. So buy HDFC Limited instead of HDFC Bank. These are called arbitrage opportunities. Then their fourth and fifth strategy is buy stock or index futures at a discount to cash market. Normally, future trades at a premium to the cash or spot price because of interest cost, funding and carry. Sometimes due to market stress or heavy shorting, the future price end up less than the cash price. So instead of buying the stock in the cash market, you buy the future contract at a discount and hold it till expiry. On expiry, futures and cash price converge. So you effectively get exposure to the stock at lower price. Now the big question at the moment is, can all these strategies help Parag Parikh large cap fund generate alpha over index fund? Well, at the moment it is too early to predict. That is something only time will tell. So for now, I would still go with a Nifty 50 index fund or a Nifty 100 index fund over Parag Parikh large cap fund. But given the reputation of the fund house, I'd like to keep a close eye on their large cap fund. Now the next question is, if someone is already holding Parag Parikh Flexi Cap Fund, is it worth adding Parag Parikh Large Cap Fund? In my opinion, it does not make a lot of sense to add this new large cap fund if you already have Parag Parikh Flexi Cap Fund. Because Flexi Cap category has more flexibility to identify opportunities in mid and small cap space and effectively generate a higher alpha over large cap in the long run. And effectively, if you look at Parag Parikh Flexi Cap Fund today, 70% of the money is already invested in large cap. Hardly 5-6% is in mid and small cap, and rest is in debt. So there would be a lot of overlap between Parag Parikh Flexi Cap and large cap fund. So overall, if we conclude, instead of competing with other large cap active funds, Parag Parikh Large Cap Fund position itself closer to an index fund, but with smarter execution. If these small efficiencies compound over time, the fund may marginally outperform the index. But even if it does not, low cost would ensure the investors don't lose much. That said, expectation needs to be very clear. This fund is not meant to beat the market decisively. It is meant to deliver index-like returns with better execution discipline. For most investors, a simple Nifty 50 or Nifty 100 index fund still remains a perfectly valid and proven choice. If you already hold Parag Parikh Flexi Cap Fund, in my opinion, adding this large cap fund does not add much value due to high overlap and limited incremental diversification. In any case, I would strongly recommend closely watching the interviews of Mr. Rajiv Thakkar, who is the CIO of Parag Parikh Fund House. His clarity of thought is exceptional. Also, if you are serious about investing, you must read the book Value Investing and Behavioral Finance. And in case, if you are someone who needs guidance with investment, you can also explore my exclusive weekly video series. For more details, you can check out my website or join button of this YouTube channel. So that's it from my side. I'd love to know your feedback on this new fund offering by Parag Parikh Large Cap Fund.